genuine savings is a necessary part of the home loan application for most home buyers in Australia. It gives a lender an indication about you as a borrower, so it's important to grow your savings before you apply. Today, I'm interviewing Sarah Moore, a home loan specialist here at Lendy, to explain what counts as a genuine savings and what doesn't, why lenders require them, and how you can still buy property without them. Welcome back to our channel, Sarah.
Hi, thank you.
Let's jump right straight into it. What are genuine savings and why do lenders require it?
So, genuine savings is a term used to describe money that a home loan applicant or applicants has saved up over a period of time. And typically that needs to be 3 months or the last 3 months. So genuine savings shows a lender that you are capable of budgeting and managing your finances responsibly. It also indicates that you'll likely be a low risk borrower. So this is a large priority, I suppose, for many lenders. Even if a large lump sum of money magically appears in your bank account 2 weeks before you submit your home loan application, it doesn't tell the lender much about you. So they're interested in knowing that you'll be able to be responsible and be able to handle a major financial commitment. Banks will be particularly wary of lending to those borrowing over 80% of the purchase price and those who don't have sufficient genuine savings, because lenders' mortgage insurance or LMI will be charged and they may be held accountable by insurance providers.
Okay, so given that banks do put a lot of emphasis on having genuine savings to get a loan, what counts as genuine savings and what is not?
Yes, well, lenders have different policies about what they regard as genuine and non-genuine savings. So it's a good idea to speak to a mortgage broker or a bank directly to learn more about that. A few things that may be considered or counted as genuine savings might be money held or saved up over the last 3 months within a transaction account, managed funds and shares that, again, have been held for the last 3 months, term deposits that are held for at least 3 months, first homeowner super saver scheme contributions, equity held in an existing property, or profits from the sale of another property as well. Note, though, that what one lender considers as genuine savings, another might consider as non-genuine savings. Home equity held in an existing property is a good example. So it's really important that you make sure you keep track of documentation like bank statements to submit as proof of genuine savings. And what isn't considered or counted as genuine savings are lumps of money that you have received through a gift or in another way. Non-genuine savings may also include things like an inheritance or gifts or work bonuses, for example. Short-term savings, so money saved over less than 3 months. Profits from the sale of a car or other non-property assets. First homeowner grant is not considered as genuine savings. Any other type of borrowed money. A tax refund and equity held in an existing property can vary between lenders.
I've seen a lot of customers asking if lenders would consider rent as genuine savings. What's your advice on this, Sarah?
Look, yeah, some lenders will consider, existing rental repayments as proof of capacity to repay a loan, usually in lieu of, typical genuine savings. It's generally better not to rely on rent paid as a substitute for genuine savings, as not all lenders will allow it. Some lenders will even consider consistent extra repayments towards a personal loan as a substitute for genuine savings, depending on the lenders. So it's always worth doing a little bit of research, maybe speaking to a mortgage broker and seeing what the best options are.
Yeah, that's fantastic. So far, we've got a pretty good idea about what is considered genuine savings and what's not. For those who have just started out on their home buying journey, I guess the big question would be that, can you actually get a home loan without having genuine savings? What's your take on this?
Yeah, you can. The short answer is yes. You may be able to be approved for a home loan if you don't have sufficient genuine savings. While there may be options, you'll need to come up with a deposit of at least 5% or ideally more, which can come from other non-genuine sources. A guarantor is a really good example. That might be an option to consider for those that don't have a deposit. Speak to a broker for advice on this, though. Whilst there are some options out there, it is a little bit more risky. So it is worth getting the advice up front.
Yeah, that makes sense. And thanks, Sarah. Finally, before you go, what advice would you give our viewers on how to grow their genuine savings?
It really requires consistent long-term effort. So at least 3 months prior to your home loan application, you need to start accumulating savings. It's a good idea to divert a fixed amount of money from a paycheck, for example, into a savings account each month. Most banks will usually allow you to set up an automatic transfer. Lots of great budgeting and savings tips out there, and it's all about figuring out what works best for you and what you can actually stick with. So there's resources on our website, so make sure you can check out any of our blogs for some handy tips on how to save for a home loan deposit. But yeah, really, you've just got to stick at it.
If you're looking for more information on how much deposit you will need to buy a property in Australia, check out our video here where we will break down the 7 key things you need to know about saving for a deposit. See you guys there next time.